Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Boc Hong Kong Holdings Limited annual report. Boc Hong Kong Holdings Limited offers a wide range of banking and financial services to its customers. The company operates through four main segments: personal banking, corporate banking, treasury, and insurance. In the personal banking segment, the company provides various deposit accounts, mortgage plans, corporate deposits, payroll and e-check services, as well as cross-border financial and remittance services. It also offers a range of insurance products, including life, medical, travel, and family protection insurance. The corporate banking segment caters to the needs of businesses, offering business loans, asset pledge, syndicated loans, accounts receivable financing, machinery and equipment financing, SME green financing, and project financing. The company also provides trade finance services, investment, treasury, corporate collection and payment, e-commerce, and card services. In addition to these services, Boc Hong Kong Holdings Limited offers wealth management and overdraft services, mandatory provident fund schemes, private and corporate banking services, internet, phone, and mobile banking services. The company also provides a range of credit facilities, including business comprehensive insurance plans, property, liability, group, and retailer comprehensive insurance plans. The company's treasury segment offers securities, funds, foreign exchange services, precious metals and FX margin services, currency-linked investments, bonds, market information services, monthly savings plans, and structured products. The insurance segment provides a range of life insurance products, including RMB and personal life insurance. Overall, Boc Hong Kong Holdings Limited is a comprehensive financial institution that offers a wide range of banking and financial services to its customers in Hong Kong, China, and internationally. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for BOCHK Asset Management Limited can be identified through various key performance indicators. Revenue growth is primarily driven by steady increases in assets under management and operating income, as well as a significant rise in person-to-merchant transaction volume. The growth in BOC Pay Plus users also contributed to the increase in revenue. Additionally, cross-border business saw a substantial year-on-year increase in sales volume of RMB funds distribution business. Fee and commission income from various sources, including associates and joint ventures, also experienced notable growth. On the other hand, revenue decline is primarily attributed to a decrease in interest income. This decline may be due to changes in market conditions or shifts in customer behavior. Despite this, the overall revenue growth remains strong, driven by the various factors mentioned earlier. The net income of the company experienced fluctuations over the years, with a notable increase of 5.3% year-on-year from HK $39,118 million to HK $41,189 million. However, on a half-on-half basis, it decreased by 19.3%. The net income also increased by 16% year-on-year in another instance. Despite these variations, the overall trend shows an increase in net income. The profit margins of the company underwent significant changes as well. The operating profit margin remained relatively stable at 65.3% and 65.6% in 2024 and 2025, respectively. However, it decreased from 64.6% to 62.3%. On the other hand, the profit before taxation margin remained stable at 62.9% and 63.2%, but decreased significantly from 51.1% to 43.9%. The net income margin increased from 54.1% to 55%. The reasons behind these changes are not explicitly stated in the provided text, making it difficult to pinpoint specific factors contributing to these fluctuations. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, the company has achieved a significant net cash inflow of $160,660 million in operating cash flow. This positive operating cash flow is a crucial indicator of a company's financial health and stability. It suggests that the company is generating sufficient cash to meet its operational needs and invest in growth initiatives without relying on external financing. The company's debt level and interest expenses have undergone significant changes. According to the extracted summaries, total liabilities increased by $1.014 billion from $3.09 billion to $4.104 billion, indicating a substantial rise in debt levels. Additionally, total financial liabilities also saw an increase from HK $3,111,132 million in 2024 to HK $3,611,682 million in 2025. On the other hand, interest expenses have decreased significantly. The company's interest expense decreased by 22.6% from HK $37,105 million to HK $67,444 million, indicating a substantial reduction in interest payments. Furthermore, interest expenses related to deposits from customers, debt securities and certificates of deposit, and subordinated liabilities also saw decreases. Overall, the data suggests that while the company's debt levels have increased, its interest expenses have decreased significantly, indicating a potential shift towards more cost-effective financing options or reduced borrowing costs. The financial performance of various segments and regions has been mixed in the recent period. On a positive note, Hong Kong, Macau, international markets, Southeast Asia, personal banking, treasury, insurance, private banking business, and cross-border business have all performed well. These regions and segments have shown significant growth, with some even exceeding expectations. However, not all regions and segments have fared as well. Corporate banking has seen a decline of 33.3%, while the Europe segment has experienced an 8% revenue decline and a net loss of $0.2 billion. The others category has also seen only a modest 4.8% increase in growth, with no significant expansion mentioned. Overall, it is clear that some regions and segments have outperformed others, but there are still areas for improvement. Management is cautiously optimistic about the company's outlook, citing a stable interest rate environment and a strong balance sheet. They plan to adhere to a robust investment strategy that promotes steady growth in asset management business while capturing market opportunities. The company aims to seize opportunities arising from market developments and expand its global customer base. This will be achieved by enhancing product and service capabilities and focusing on strategic markets. Management also emphasizes the importance of risk management, conducting stress tests and setting limits to mitigate liquidity, credit, equity, fund price, and currency risks. In addition to financial growth, management prioritizes deepening corporate culture through their strategic development plan. This includes promoting ethical behavior, prudent risk-taking, and fair treatment of customers. The company will also implement its medium to long-term strategic plan, reviewing major investments and capital expenditure while developing key businesses through a specific strategy. Overall, the company's outlook is focused on steady growth, risk management, and cultural development. Management aims to capitalize on market opportunities while maintaining a strong balance sheet and robust investment strategy. Based on the provided information, it can be concluded that the company has indeed paid dividends. This is explicitly mentioned in two separate sections of the document, further emphasizing its accuracy. The confirmation from multiple sources adds credibility to this fact, leaving no doubt about the company's dividend payment history. Concerns about inventory buildup and supply chain disruption exist. There are valid concerns regarding the potential for inventory buildup and supply chain disruptions in various industries. One specific area of concern is the worsening of global supply chains, which can have far-reaching consequences on businesses and economies. The risk of inventory buildup arises when there is a mismatch between demand and supply, leading to an accumulation of unsold products. This can result in significant financial losses for companies and may also lead to waste and inefficiencies in production processes. Supply chain disruptions, on the other hand, refer to any event that interrupts the flow of goods from suppliers to customers. These disruptions can be caused by a range of factors, including natural disasters, transportation issues, or even cyber attacks. The potential consequences of inventory buildup and supply chain disruptions are significant, with companies facing financial losses, damage to their reputation, and decreased customer satisfaction. That concludes the financial summary for Boc Hong Kong Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.